Okay, hello and welcome everyone to this live intraday strategy webinar on SB Trade Desk. Michael Boutros here with you this morning, guys. We're about 30 seconds out from the durable goods orders here in the United States. Also looking at cap good orders, non-defense, which is a good gauge of business investment. Expected print for September is negative 1.5%. That's down or a little bit of an improvement rather from a negative 2.3% the previous morning. Permendra, David, Aurelian, Christopher, Farouk, Mark, we got the whole crew in here today, so good morning to all of you guys. Good to be back. In just under 20 seconds. Hey, Christopher, I'm doing well, man. Thanks for asking. Guys, as always, throughout the course of the session, questions, trade setups, specific pairs you're looking at, feel free to post them on the message board. First things first, let's get this print out of the way. Durable goods orders for September. Expected negative 1.5% comes out at negative 1.2, slightly better than expected. Durable goods ex transport, negative 0.4, slightly worse than expected. Non-goods, here it is, or goods non-defense rather, comes in worse than expected, and a little bit of a downward revision to the previous month. So broadly speaking, although we did beat a tad on the headline durable goods orders, it's a weak print. Okay, it's a weak print. You got downward revisions pretty much across the board. Specifically, the deepest downward revision is on the headline figure. And orders non-defense, again, negative 1.5% does not bode well for broader business investment. So you're seeing the dollar index here coming off. Looking at a near-term support structure here, just a basic trend line support off of the lows that we made for the month. And that comes into focus right around just below 12,000, around 11,993. Relative performance so far versus the greenback. Taking a quick look at the dollar performance overnight, you did see that the dollar is weaker against all its major counterparts save the Swissy. Kiwi up 0.52, Aussie up 0.46, Euro. I'm sorry, guys. This is from last Friday. Let me update that. I didn't seem right. There we go. Yen, top performer, up 0.71. We'll definitely take a look at the yen. Performance here, or where the yen is sitting right ahead of the Fed, is absolutely critical. So we'll take a look at that. Kiwi up 0.2, Swissy and Euro up 0.11%. Aussie, Sterling, pretty much unchanged on the session, which is funny because yesterday's intraday update highlighted both of these setups. I still think there's a lot of potential here. They're kind of just stuck in their weekly opening ranges, so we'll go over those in a moment. Loonie with a decline here of 0.17%. All right, so first things first, let's just go over a quick look at where the dollar index is trading. We'll jump into the Aussie and Sterling, and then the radar charts are actually what I've been operating on again last night. I was messing around with that Kiwi CAD. I didn't pull the trigger. It is very close. It's at a major resistance level. It's poking its head through right now, but we'll take a look. And Aussie Yen also looks primed. I actually did jump into a little position on that one. For those of you who are able to trade gold at a critical juncture as well, opening the week at support. All right, let's jump right in, shall we? First things first, here's what the dollar index looks like on the daily basis, and then we'll jump into the 30-minute charts. So dollar index, we highlighted this early in the week on the Sunday radar chart. Look, at the end of the day, this thing was just coming into a major resistance at the confluence of a basic 786 retracement from the decline off the highs we made in September. Came in at 12,051. The high was actually 12,054. And then a basic median line parallel resistance. If this structure is operative, and again, we do have a little bit, it's a little too early to put too much reliance on it, but you did see that the median line off the high caught the exact low that we made there for August before the rebound. And here we are with this last rebound, again, catching that high. Remember, on the invalidation level of these broader daily charts, it's really all about the close. And if you bring it to a close, well, that looks awfully clean. Okay, so dollar index remains at risk below that 12,051 level heading into FOMC tomorrow. Obviously, guys, it's going to be the major highlight for the week. Do get GDP figures the following day, so there's going to be a nice jam-packed session right into the close of October trade. We do want to keep in mind that as we go through these intraday setups, the closer and closer you get to the close of the month, the open of the month, we want to reduce our leverage. We want to be a little bit more nimble. A lot of back and forth action. Portfolio rebalancing can really wreak havoc on some of the near-term technicals. So just keep that in mind. Obviously, ahead of tomorrow's highly anticipated FOMC interest rate decision, we will have another intraday strategy webinar. So we'll go over all those setups one last time to see where they're positioned right ahead of the interest rate decision. No expectation from the Fed as far as easing, obviously. There's one interest rate decision left for the year in December, and if they're going to make good on this 2015 hike, that's the last meeting that they could potentially do that. Now, a lot of the focus tomorrow will be on the language of the statement. Remember, we're not going to get a presser. There's not going to be any projections. It's just a run-of-the-mill interest rate decision. They have postulated multiple times that this is a quote-unquote live meeting, which means they can move on policy. It's highly unlikely that they'll want to do that without having the presser to disseminate the details of how they're looking to, or how they're gauging what the current performance of the economy is. Long story short, we'll go over that again tomorrow. Dollar index at risk here below 12,051. Here's what the 30-minute looks like. Before I jump into it, I just want to show you one other thing. That 100-day moving average has been a very nice, decent pivot in price pretty much for the entirety of the year. Okay, that coincides with a basic trendline support off of the August low. We broke through it, obviously, acted as some resistance. We popped right through. Coincides dead on right there around 11,970 or so. Okay, so that's the next sort of major support here for dollar index near term. Also coincides very nicely with that swing high that we made back on the 14th. Okay, so this is what it looks like on the daily. Here's the 30. So this was also on the radar charts on Sunday. The major, again, basic trend line off of that high. Yeah, that 786 retracement, 1251. And here's the pull to the downside. Momentum gave us some strong divergence into that right into the close of the week. I'm not really a big fan of using these divergences into the close of week in the next session, but we're looking for that drop into trendline support, and that's really what would validate a near-term correction here in the dollar and really shift our focus more aggressively to the downside. Remember, ahead of today, the dollar index, or ahead of this week, the dollar index had a 7-day consecutive rally. Okay, we haven't seen that since the financial crisis. And a great way to bring that up, guys, is you can bring up this indicator called consecutive bars. You can find this, I believe, on fxcmapps.com. And if we do that, you can see that this 6 days doesn't count the first day. Obviously, that's up. So a 7-day advance or a 6-day advance here consecutive. The last time we saw that wasn't until way back here. Now, those were just on the onset of a major rally during the financial crisis that took us into the highs. But relatively speaking, we're in a very different position from where this is. I just wanted to highlight that. You know, this is coming off of a major low in price, and on the reversal, you'd expect to see some consecutive day advances like this. This is a very different scenario. You've now posted a 6-day consecutive 7 straight up days at the highs. So a little bit of a different of a scenario, but certainly gives you room here for caution as far as a possible pullback here in the dollar. If it's going to happen, it's going to be Fed charged, and we'll have to wait to see what the Fed has for us tomorrow. Any questions on the dollar index, both near term or long term? Basically looking lower sub 12,051, 12,050, and it breaks sub 12,000, looks for that run into 11,970, 11,980. That's this region right here on the daily. That's this region right here on the 30-minute. So where does that leave us, relatively speaking, on the dollar crosses? Well, certainly leave some up room for the Aussie, some up room for the sterling. Euro's already starting to make a move here, but again, heading into the close of the month and FOMC, I just want to really stress the caution point here, guys. Anything I've been trading has been half leverage this week so far, and it'll probably be that way until we get into the end of the week. Christopher says, no questions. I just wish I could trade it. You and me both, my man. But doesn't mean you can't benefit from the analysis off it, right, Chris? For those of you stateside, you know we can't trade the Dow Jones FXCM dollar index, but a really good tell of broader market move, broader dollar base movements, because at its inception, unlike the ICE dollar index, which is almost 60% weighted the euro, at its inception, this index is the Euro, Sterling, Aussie, and Yen, just the four most liquid currencies, most traded currencies versus the dollar. The ICE index is heavily weighted the Euro and has a basket of 6, right? So definitely can benefit from just taking and keeping a broader look at what the dollar is doing in and of itself. All right, now we have a picture of what's going on here in the dollar. Let's jump into some of the crosses that we've been following on the intraday chart. So here's what last night's update looked like on the Aussie. No plays here, really. You're looking for topside triggers while above 7,200. 7,200 is what we raised the bullish invalidation level. If you remember the Sunday update, we were looking for a break of the focus range, which was 72 into 72.37. You saw that topside break. Initial targets at 72.60 got taken out. Subsequent targets at 72.80 didn't. We failed right ahead of it. Pulled back. In overnight trade, we broke down even lower, but still thinking we could move higher from here. Here's what the Aussie dollar looks like on the daily. So before we get into the 30-minute, it's important to note where this thing is relatively speaking. And the major support that we highlighted again on Sunday was right here. Okay, 71.80 essentially into the 72.02 handle. Major support, decent pivot in price. And you're really looking to get back above this median line, back above that 200-day moving average, or 100-day, excuse me, to get the validation for the continuation higher. If we break lower, you're looking basically for a drop into 71. Okay, so you have the relative sort of pivot that we're looking for the Aussie while above 72. Here's what the 30-minute looks like. Oh. All right, so you saw us make another run at that 72.50 level, and it failed in overnight trade. Here's the move back to the downside on an outside candle. Likely to see a drop towards 72.14. That's where we started off the week. Even 7,200, which would be a nice median line. And again, that's the bullish invalidation level. So I'll be looking for long triggers as we come into this region. Momentum hasn't really been anything so far to start the week. You started off peaking above 60, but then we've held 60 as resistance ever since, and we've held 40 as support ever since. That's as a flat or a ranging market. Okay, Raj will definitely go over the Kiwis, asking, is it the same for the Kiwi? We'll definitely take a look at that. I think it's a little bit of a different scenario on the Kiwi, but broadly speaking, it's a similar setup. Remind me, let me write that down. We'll definitely go over Kiwi dollar. I've been interested in Kiwi CAD as I wrote about yesterday, but we'll definitely look at Kiwi dollar as well. So for the Aussie, here's what it looks like on the 5-minute chart, just to give you a picture of what sort of the performance looks like heading into U.S. trade. Pretty sure I had an Aussie chart. Oh, here it is. So this is just the performance over the last few sessions. Okay, here's your Sunday open. The opening range strategy, just to give you a quick heads up, has been working intraday for these trades, but they've been very short-lived. Meaning if you do see an opening range break, you're going to get a little bit of a run, but it sucks right back in. And again, that's going to be a function of the fact that you have major event risk on tap. Remember, for Australia, we do have CPI figures later tonight. And then we also have FOMC tomorrow, US GDP the following day. So a double whammy from every side you look at it for the Aussie and the Kiwi. But looking at the Aussie dollar here, again, 7,200 sort of where I'm looking for possible support. Chris Hudson says, honestly, Aussie dollar would be more tempting on a short against 73 area than a long around 72 to me. And I am missing something there, Mike. A short against 7,300. So it depends what you're looking to do. From a swing trade, that might work. Chris, from my standpoint, look, this thing, let me take a step back. The reason that I'm looking higher, broadly speaking, he says that's if price got closer to 73, of course, not from here. Yes, in that type of scenario, you'd be pushing up against the median line, you'd be pushing up against a key 618 retracement, absolutely. But I wouldn't be looking at target 72 on that. I'd just be looking to target initially 21, 22 pips, and so forth. strategy doesn't change, right? But the reason is this: on the decline off the high, we've essentially created two equal legs lower. It's 100% extension, 71.78. We just came shy of it on that last stretch into the lows last week. The low is 71.80. The extension sits at 71.79 if we round up. So on that basis, two equal legs down, an ABC correction keeps the focus higher. Not just that. Here's the sort of validation for the idea. Okay, if this median line parallel is in play, which certainly at this point, looking back, you've seen so many tags, and I think we do have some justification for using it. Resistance, resistance, break, support, little dilly-dally there. Resistance, break, support, 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 support. And on the upside, although we didn't make it, there's the breach. So the median line parallel also comes in at the weekly opening range low. Beautiful. Happens to be the weekly opening range low took shape just above key support rather. So there's a lot down there. Okay, if we're gonna get a bounce, this is the region you'd want to bounce off of. A rally into 73, into the median line, into that 100-day moving average. Sure, Chris, a short exposure or a short scalp bias from there does make sense. Absolutely. But just keep in mind the broader structure that we're trading with it. And if we make it above that median line, which is essentially topping 7,300, you're looking right back up at 73.86 and 75.34. Chris, does that make sense, sort of where I'm looking on the Aussie here? I mean, look, you got a big week ahead of you as far as Aussie data tonight, U.S. data tomorrow, U.S. data on Thursday, close the week on Friday. Could be a decent game plan for see a move back to 72, tested as support. If that breaks, you're looking right back into 71.80, and sub 71.80 risks much, much steeper declines. 71.58 would just be a soft target. You'd essentially be looking for a drop down towards that 71 handle. He says, yes, it makes a lot of sense. I have to work on perspective. Yeah, Chris, he says there are trades that I overlook sometimes. 100%. I like where your head's at and where the idea is on that trade. But it's very, and this is why a lot of people ask me, why do you spend so much time? You're basically making every chart twice. You're making a 30-minute and a daily chart. Well, that's because I need to know what the broader picture is doing. If I'm just zoomed into a 30-minute chart, or even worse, a 5-minute chart, I have no clue what the broader picture is doing, right? As much as you zoom out, it doesn't matter. So it's important to keep perspective of where the broader trade is. So we'll see if that pans out. One other thing I did just want to bring out, guys, is you have a basic trendline support here I'd be watching as well, right off last week's low. Could catch things if you come into here and you see a nice long trigger taking spot. A stop against the lows for the week might be a decent long. But at this point, we've moved too far off the highs from, I think, Europe to really try pressing any short exposure from here. And look for that intraday momentum to finally clear 40-60. Remember, this is the ranging market signature more than anything. All right. So that is Aussie dollar. If there are any other questions on this, feel free to throw them out. A big one over the next 24 hours with the double whammy here from Aussie and US data. As always, I do see some new names in here, guys. If you have any, or if you want to take a snapshot of any of the charts that you see presented here in the webinar, feel free to go to the top-hand corner of your GoToWebinar screen, little camera button there. Go ahead and click that, and it'll take a freeze frame of any of the charts. So if you need to refer to these levels later on, they're always available for you. It's a pretty cool option for the software. All right, Raj is really interested in Kiwi, so I'm going to segue real quick into Kiwi for you, Raj. I'm taking a look now, buddy. Here's what the Kiwi looks like. So this wasn't highlighted yesterday necessarily on the intraday charts, but we did talk about it in the radar charts on the previous session. So here are the radar charts from Sunday night, and here's what Kiwi looked like. Okay, we started off the week just above key support confluence, 73.37 into 67.34. into 67.40. Major key support, a nice confluence of longer term and near term fibs, and the former upper median line parallel that we broke through last week. Checked it as support. So we were looking for a rally here towards 67.83, and a break there is what would shift the bias moving higher towards 68.14, 68.19. We got a break yesterday and it failed ahead of 68.14, came right back down. Doesn't change the setup, but the trade just doesn't have momentum. Keep in mind, as far as New Zealand is concerned, we do have the interest rate decision later tomorrow, right after the Fed. Obviously, we're looking for them to hold at 2.75%, but another one which does represent a big event risk heading into the latter part of the week / close of the month. But here's what the setup looks like now. The levels are dead on, guys. I know that the trade looks messy, but the levels are dead on. I wouldn't change one thing. Here was the break that you saw. You came back and tested the opening range high, okay? Or you tested that resistance, rather. We pulled off. We tried to break above failure, okay? But this drop that you saw yesterday was on New Zealand trade balance figures, which were much weaker than expected, okay? Here's what the trade balance figures look like yesterday from New Zealand. You came in at way deeper than expected on the deficit. Exports also decreasing, imports increasing. So the broader trade deficit got much, much deeper. And you saw a quick slam in the Kiwi all the way from 67.80 right into that key support and a rebound right higher. Okay? That keeps the focus higher. When you see a move like that, that's the market telling you, nope, no bids down here. Okay? We move right up higher. Or lots of bids down here, rather, and we move right higher. Near term, this is Kiwi Resistance. Okay, so the only thing that we've added here, let me zoom this out a little bit. The only thing we've added here is a 618 retracement off the high, same exact level. The only thing that we've added is this pitchfork. And there's a lot going on here, guys. I'm going to explain it in one moment. So before this, we were focused on this pitchfork heading into the week. Held price action all throughout the week last week. The lower median line parallel caused nice rebound. The break of the upper median line parallel fueled the rally. Here we are testing that as support into the close of last week, and it held. Now that we've made that new high, a new median line structure, taking just the highs that we made for the month, gives the upper median line parallel guidance into the 618. Again, that's 68.14. So I know on the swing side of things, stops at 68.70. You got a lot of room. That's above last week's high. I would look for a near-term bearish invalidation with a break here. So if you do get a 68.14 break, expect to see that test of last week's high. If this holds, which is the preferred scenario, if you look at momentum, we've been holding 60 all through the highs here, then you'd look for that pullback or short triggers as close to 68.14 as you can get. Let's see what the 5-minute actually looks like. We're getting pretty close there now. Let's see what the 1 minute. So the 1 minute still looks a little constructive, right? On the 1 minute charts, and the deeper you zoom in, guys, the more messier you'll see 60 breaks, 40 breaks on the downside. But if you look at the momentum signature just from the start of London trade, which is in green here, you can see 40 has held support on every stretch. 40 hold, 40 hold, 40 hold, 60 break, 40 hold, 60 break, 70 break, even stronger. Little dip below 40 here, but a quick recovery back above 70. You'll look to see that change as we head into U.S. trade before we start shorting this thing. Remains constructive near term. Bearish invalidation for the broader structure we're looking at here would be just above 68.19. So Raj says, I want to be short Kiwi dollar, just hit resistance. Yeah, I think you had just a couple of more pips to go before you're actually at resistance, but I do see what you're looking at, and if the momentum signature holds 60 and you get some short triggers into the open of U.S. trade, 930, 945, I'd be all over that too. He says, what about if we get an hourly reversal candle now? If we get an hourly reversal candle, Raj, also, that's a great indication that the trade is turning over, 100%. But from a scalping standpoint, you probably already missed entry. Guys, it's important to keep in mind the different types of techniques we use to ascertain bias. Hourly key reversal can be very helpful in swing trades, and in fact, can be a very nice trigger when you're working with a little bit bigger of a stop. You're looking to take a little bit bigger of a chunk on the gains. But when we're looking intraday, and on a trade like Kiwi, a quarter of the daily ATR is only 24 pips. An outside key reversal on the hourly basis, you may have, lost a big chunk of that range already. So I hope that offers some color. But I am looking for resistance just above 68 here. Chris Hudson, great C, says, Mike, do you think a short Kiwi works with a long, I think you mean bias, on Aussie, just 10 to 20 pips lower? What makes Aussie rally would be similar market conditions to what would make the Aussie rally, right? Okay, let me read that again, Chris. What makes, I think, the Kiwi rally. No problem. I can read through typos. Hey, my typing is worse than yours, man. I got typos all over the place. Right. I see what you're saying here. You could definitely take opposing positions like that. And in fact, a lot of times I like to do that just to hedge myself in a little bit. They're not always going to work in tandem or against each other, guys, which is why you look at a trade like Aussie Kiwi can sometimes give you a tell of what's going on. Aussie Kiwi broke a major key support last week or earlier this month, essentially with this move here. As long as we hold below 70, 107.25, 107.30, then this thing is still bearish. So that could be excessive Kiwi strength, which blows through our stops, or it could be heavier Aussie losses. And in this case, the case might be for Aussie losses if we head into CPI comes out weaker than expected, especially if the dollar rallies. 72 break here. We already went over the downside targets. Graham says, hi, Michael, case for Aussie Key. Yeah, so I think I stole the words from outside of your head. Absolutely. Big position here for Aussie Key. 105.57 is what I've been looking for on this down stretch. We just missed that last week, but that's a key 618 retracement of the entire 2015 trading range. Don't have anything compelling on the Aussie Kiwi scalp per se, except just to highlight this near-term median line formation off of the August and September highs has been guiding price action pretty nicely. What looks to happen right now is it looks like we've just broken the initial opening range low for the week. So this is the weekly opening range. We made a low, tested the high. We tried to test the lows yesterday, failed. Couldn't even make it back above. Break to the downside, keeps the short side in focus, essentially sub that 106.50 level, 106.58. Momentum signature coming off constructive, divergence into the highs, 40 break. Could be a little bit more of a drop to the downside here for Aussie Key. Might be an interesting one we should talk about tonight. We'll take a look at it. Raj says, thanks. Oh, okay, for the Kiwi, Raj. You're welcome, man. I hope that offers some color on that. Mark says, Kiwi, why not put the lower parallel at the 1021 on the line chart if it's the low? I mean the other 1021. Oh, this one. So it's not necessarily going to be, Mark, a science, right? A lot of technical analysis is very subjective, which is why there's so much analysis that you can find out there. And there's always someone saying bull, always someone saying a bear. With this, you're looking for what slope is going to offer best explanation or best guidance or best illustrates price action. I could do this, sure, right? But you'll see that We kind of went through support here, popped right through it again. Either way, we're highlighting the same region of resistance. It's just that when I bring this down to this low, right, gives a little bit more conviction on the pivots that we've seen in price, and on more of just sort of a messy drop into this pivot, still holding the median line. Either way highlights the same region. So it's what fits price action best. Now, I say that with a very, very important stipulation, okay? We never want to make or tailor our analysis to just fit price action. It's not always going to be in your best interest, Mark, to use the high, the absolute high and absolute low. You'll see a lot of setups in both my analysis and Jamie's where the extensions, median line parallels, and the median line itself is not necessarily going to be taken off the high, low, high, or the low, high, low. Okay, so just keep that in mind. It's what's going to best define what you're seeing in price. And if we look at the pivot that we made here, if we look at the broader support that we came into last week, it just seems to be, in my opinion, a little bit better explained by that secondary low or the primary low first. Does that make sense? Mark says, gotcha. All right. Okay, I think I'm on par with the questions. Chris, I got you. Mark, we'll take a look at dollar CAD for sure. Raj, Kiwi, we got. Craig, and the Euro crosses, we'll definitely go over those. All right, so let me just get through the sterling. We got some data out of the pound earlier this morning. We went over Aussie, went over Kiwi. Okay. So before we do that, actually, I want to jump into Kiwi CAD. So this is the Kiwi resistance 68.14. That's going to be the near-term bearish invalidation level. If this median line formation is in play, we should be looking for support triggers around here. Just off the session lows, there's a near-term trigger. And again, on the 5-minute, or this is the 1-minute, even if that trigger breaks, I wouldn't necessarily just be jumping into a short. I'd want to see what the US Open looks like on this because you're going against the near-term bias here for the day. Okay, so now that we sort of have an idea of where Kiwi is, initial break below 67.80 is what would set this thing off back towards key support. Here's what Kiwi CAD looks like. And certainly this from the 2 is what I've been more operative on and what I've been focused on. Kiwi CAD is coming into such a big level of resistance. We're showing a breakthrough here again, but we did the same thing last week and we closed lower on the session on Friday. Okay, we got just the highs last week was 89.65. So far we're pushing a high of 89.25. Okay, bigger level of resistance here is defined by the 50% retracement. Again, this is the 2015 range, so the entire 2015 range, 50% retracement. You got the February lows from the previous year, which has been a very nice pivot in price. And more importantly, you've got this trendline support, basic trendline support, dating all the way back to the lows that you made in 2011. Okay, tagged again in the 2013 low. We broke through it earlier this year. We tagged it as resistance, and here we are again as resistance. So this trend line right here, if we close above it, certainly would shift the focus right into the yearly open, which is 90.43. A nice rally to the upside. There's a lot of room here. Today's close is going to be paramount. I do not want to necessarily jump into a position on this ahead of the RBNZ, which is slated for tomorrow after the Fed, but certainly something that we'll have on the radar over the next couple of days. That 90.43 level, by the way, guys, tomorrow coincides dead on with the upper median line parallel. So as far as the levels are concerned, they're very, very clear. A move and a close below the 200-day moving average, which is 88.95, is really what would be needed to shift our focus back to the downside. Okay, here's what it looked like yesterday. And here's what the 30-minute looks like right now. Okay, so that initial target that we talked about on the possibility of a topside break, 89.80, we're pressing that right now. Momentum is an overbought. This just happened. So as long as that condition stands, you're likely to see this thing make a run on 90.43 to the upside. Looks like a legit break here. Look, at the end of the day, start of the week, momentum signature is 60, 40, 60, 50 starting to hold, looking more constructive. 60 break takes you through the basic weekly opening range high. Remember, here's the weekly open. And that was coincided with the first 60 break of magnitude, let's call it, for the week. Came back, tested as support, price tested that resistance as support, and moved right off. All right, we would need to break back below this specifically near term to even shift the focus lower if we do get a support trigger, but even then, you'd need to make it outside the underbelly of the weekly opening range before this thing turns over. So as it stands right now, guys, just looking at this again fresh for the first time today, it looks like we could be heading towards that yearly open, 90.43 to the upside. Any questions on Kiwi CAD? Raj has a rather lengthy question here. Let's see what he's saying. Mike, have you noticed support resistance is the most talked about thing in trading, but market knows where all the stops are, and they always aim for our stops because they know where we place our stops, previous highs and lows. Raj, so what's your point? You're thinking it's sort of like self-fulfilling prophecy, right? If everyone's looking at resistance at this region, market is going to run it and then come back, right? It's been the name of the game since the beginning of trading started, Raj. It's all about market psychology, which is why I don't personally, I don't subscribe to anyone else's research, right? I don't like to read, what other analysts and banks and other guys are looking at, because trading is a very personal thing, Raj. It's not just about identifying support and resistance on a black and white piece of paper. It's how you react and how you trade around those levels. So yeah, this was resistance. You're absolutely right. This could be a false break. You're absolutely right. Guys could be trying to run people's stops, and then they'll slam this thing lower. That's where the technicals give you guidance. And we're not just talking about identifying levels, which is what you're talking about, support and resistance. For me, that's where momentum comes into play. So we're coming into resistance, but is momentum fading? Is there a short trigger that's on tap, right? Yes, we're coming into support, but again, is the downside momentum starting to hold 40? Is there topside resistance triggers that we're looking for? Markets such as the pound is notorious for what you're talking about. Institutional traders have been known to really slam the pound around, run stops, runs limits, or comes shy of limits rather. But Raj, that kind of thinking is not going to be, what's the word? It's not going to be beneficial, right? The market's not rigged against you. We just need to be able to be objective as possible in our research and identifying these levels. Near-term trading, this is where you start to get stung, though, Raj. So if you're talking about those concerns right now as it pertains to our intraday strategy, yeah, it's definitely something that you want to keep in the back of your head. And all that means is when you come against major economic releases, when you're coming up against monthly opens, quarterly opens, yearly closes, for me, that's where I just completely either sit on my hands or reduce leverage to, a quarter of X, what I typically trade. And that's because those are the time periods that are most susceptible for those runs on stops and such forth and so forth. But just keep it objective, Raj. Don't overthink everything. If you guys are trying to read too much analysis out there, or if your Twitter stream is polluted, as mostly all of ours are at this point, with just opinions and trade biases, I try to keep it as objective as possible. It's served me well in the past. Focus on what price is doing, and price is the end-all game player here, right? But I hope that answers your question, Raj. He says, yes, sounds good. You got it. So Kiwi CAD above 89.40, guys. This thing's at risk for a rally right into the yearly open. I'm not going to really try to press a short on this, specifically with momentum and overbought condition. This can stay like this for an indefinite time period. We'd need to see this back below 70 before you even start to think of fighting that rally. So now that we've sort of taken a look at Kiwi CAD, we covered Kiwi, we covered, let's jump into the CAD real quick. Here's what dollar CAD looks like on the daily, and then we'll jump into the 30-minute. So I haven't highlighted this in a couple of days. I kind of just been sitting on my hands here as well for the dollar CAD, looking for a rally to sell early in the week. Was the game plan that we closed off last week at. Look, at this point, you're testing the 618 retracement of the decline off of the yearly high. I'd be much more interested in trying to get short closer to 33, namely the upper median line parallel for the formation that I personally have a lot of conviction on. You can see that the decline found support right at the lower median line parallel. The rally that we saw until late last week, the pullback on Friday, found support right at the median line. And that would put us on course to test the upper median line parallel, which comes in play the confluence for the current ascending embedded structure. So that's all to say, guys. It's a whole bunch of fancy words to say. I'd be much more interested in short exposure near 3270, 3280 against that 3308. 3308, by the way, is the weekly, monthly open. So we made this huge drop in CAD, dollar CAD rather, and we're just pips away from basically calling it square on the entire month. All right, so I'd be interested in short exposure up there. Intraday, here's what it looks like for dollar CAD. So here's what dollar CAD looks like on the, I probably should have put this on the radar charts yesterday, but this was on the radar charts on Monday as well, or Sunday night. So here's what we look like on Sunday night. Levels have been unchanged. We wanted to stay constructive bias while above that 3143 confluence right there. You dribbled below it yesterday, but then you closed and you opened Asia just above that key support. A break of the opening range high for Asia finally gave this thing an upside bias. It was the first 60 break of the week. Here's the first initial target right at that 618 retracement. That's 3217. We're testing that now. A break higher. Let me just snap these levels for you. A break higher, and you're looking for that 3283 level, and that completes a 618 extension off the low and coincides very nicely, like I said, with that upper median line parallel for the formation off of the yearly highs. So dollar CAD, man, it's primed. It is primed. Oops, sorry about that, guys. As far as CAD is concerned, don't forget you also do get some CAD data heading into the close of the week. Industrial production prices come out on the 29th, which isn't going to be the major market mover. The major market mover is going to be GDP figures for August. That comes in on the 30th, which is Friday. Looking for a nice bump higher. So this might be the catalyst, actually, if we're looking for a dollar CAD position. GDP on Friday, looking for August to come in at 0.1%, slightly weaker, but the year-on-year print is expected to rise to 1% versus 0.8. If we get a stronger print here, okay, especially with CPI where it is. Remember, Canada has one of the highest CPI reads of the developed economies at this point. So, you know, they're starting to look pretty good as far as being able to start normalizing policy. That being said, if you get stronger growth than expected, look for CAD strength, and that's dollar CAD lower. That's also Kiwi CAD lower, right? Depending on how the RBNZ reacts tomorrow. The RBNZ is not going to like a higher Kiwi. Wheeler's known for talking down the Kiwi, so could be a nice recipe over the next couple of days, guys, for a Kiwi CAD reversal back below that resistance. Dollar CAD looking back towards that near-term resistance just below 33 if we break this region. Immediately, though, we're at resistance right at that 618. Any questions on dollar CAD? Someone was asking about that earlier. Who was it? Mark says, dollar CAD, please. 618 at 32.17. Yes, sir. 1618 at 132.33. 32. I'm not sure where you have that 1618 off of. I have the 1618 at 32.83, and that's using these levels right here off the low, first wave up. Also, 50% of the September rally is exactly 32.33. Of the September rally. So, yeah, I wouldn't be using that retracement anymore. So, Mark Haverman, if one of the highs or lows of a retracement gets invalidated, I will typically no longer use that retracement because the levels hold no meaning at that point, right? So if this rally is the retracement you're using on the way down, once we break those lows, that retracement is null and void. Now I'm working with the retracement of the decline. You always want to work with the most operative move. He says, yeah, not really using it. It just coincides to the pip. I hear you, Mark. And that's great. When it coincides and there's confluence with something that's operative, sure, I guess. But for me, I want to keep the chart as least cluttered as possible. So whenever there's a level that's not, an operable level of the move we're in, I'll just tend to clear it out. Because sometimes you'll end up chasing, moves that or levels that just aren't warranted anymore. That being said, that 33 level you're talking about, actually the upper median line parallel comes just above that level you're noting, right around here, 32.45. So within the confines of this downside, that upper median line parallel near term, just ahead of that. Mark says, understand. All right, cool. Right on, Mark. In relation to time, Chris says, looks like CAD will miss the confluence. Do you use the technique that way? I'm not sure what you mean, Chris. Do you want to give me some more background information on that question? Meaning when the lines cross. Yeah. So look, when the lines cross, if the crossing or the confluence region is farther out in time, all that means, like let's say I was looking to target this right here. All that means is that the market can spend a couple more times not doing much. It's not always going to be a directional move towards that. I want to highlight that region. For me, it doesn't matter if I'm in a scalp and the market hits 3280 tomorrow morning, tonight, or if the market hits here. It doesn't matter really in timing where. If my position is in, I have a stop against the lows, that's the position. It could dilly-dally here and take a small crawl all the way up. I tend not to put too much influence on that. Also, Chris, remember, we're not always going to have the right dead-on slope, right? It just doesn't happen in trading. You're never right 100%. Nothing's 100%. So for me, it's much more important to highlight the levels. The slope, where they coincide, can give you reference for when in time, but maybe there was a better slope we could have used. Maybe the angle was too steep. That'll throw off your timing way off. So I'm looking for those confluence regions. I don't want to necessarily stress if it's going to miss it in time. For example, something like this was the invalidation last night. We said, look, if this thing broke below 1340, probably going to see it, right back into that key support structure at 130.50, 130.60, right? So now that confluence is no longer in play, right? The sliding parallel is higher. I'm still going to leave my bullish invalidation level there. Just doesn't confluence with that specific slope anymore. Does that make sense? Chris, let me know if you have any questions on that, or if an example comes up, just give me a shout out. I'll walk you through it. I think I understand what your question is. He says, I get it. I didn't ask the question very well, but I totally get it. All right, cool. As long as you're on the right page, Chris, that's all that matters to me, brother. So watch 32.17 on dollar CAD. Hey, you're more than welcome, man. Cheers. Possible pullback here, but I am on the stalking this dollar CAD here for possible short entry. All right. Went over Kiwi CAD. Did we go over pound? We did not go over pound. Here's what the British pound looked like. This was also highlighted on last night's intraday update. Here's what it'll look like on the daily. Major support into 53. Okay, just below 53 is that long-term multi-year median line and former upper median line parallel coincides right there. Okay, if you look at the intraday charts, we're holding in the confines of this descending channel formation, but the risk, and this is what we noted, is for a pop higher, right? 53.80 would have been a nice confluence region there. That's the upper median line parallel, basic 38.2 off the decline. And a breach there would shift would keep the focus to the upside. Inevitably, we'd be looking to sell as close to 54.50 as possible. That's the high day close for the month. Here's what it looks like intraday. So again, we came back today and tagged that perfect former upper median line parallel. This is a long-term structure dating all the way back to the highs that we made back here at the start of January 2013 trade, the January lows that we made in March, subsequent 2014 high. You can see how many pivots we've had along that region. Okay, so it's make or break here. You're heading in some serious levels for the pound again. This is what happened last time. We kind of broke through this and failed, ran right through. It was one of the largest range days that we've seen in the pound in months. And here we are right back again, testing that same key region. 30 minutes pretty clear. Here's what it looks like. Recent price action has been chopped up to hell, but it's still, the levels are unchanged. You're looking at support at 53.07, that 50% retracement. Again, that longer term median line we looked at in the daily chart, even near term, just off the lows from late September, early October on the first basic trend line support, all right there at 53. So you know where support is. Resistance, well, that level looks pretty clean too. Right here at that 53.80 level, 38.2 retracement, coincides still heading into the close of U.S. trade today with the upper median line parallel. This is going to be the bearish or the bullish invalidation idea. So if we break back below 53.08, the weekly opening range low, you're looking for targets at 52.60 and 52. On its face value, guys, the British pound has just set a beautiful weekly opening range above support. That's all that's happened. So if you get a topside break of the weekly opening range, you look for that late week high. If you get a downside break of the opening range, you look for that late week low. Opening range strategy has been working out beautifully for the pound. Here's what last week looked like. Sunday, you run into a high on Monday. You test the high following day, it fails. You test the low, that failed for a while until the 21st, open of Asia. You see a downside break, but on a test of the opening range high, we fail, close the week at the lows. So remember, opening range strategies for anyone who's new to the room, you're looking for the market to set a high and a low early in the week. Could be Sunday, Monday. It could be Sunday, Tuesday. Just the first couple of sessions, you're looking for a high, a low, and the market to go back and test one of those highs and lows. Once we break that, gives us a directional bias for the week. Not a straight trading strategy in and of itself, but certainly a nice tool to help us ascertain near-term directional bias. So for me, if we break back below the lows here, you're likely to see this thing fall apart pretty quick. 52.60 would just be an initial target on the downside. But I'm just looking for long triggers well above this region. As far as the British pound is concerned, also, you did get some data out of the UK yesterday. Okay, so data out of the UK yesterday for third quarter advanced read on GDP came in weaker than expected on both prints. Quarter on quarter came in at 0.5, expected 0.6 year on year, 2.3, expected 2.4. So a little bit softer on the growth prospects. They've been a little bit softer on inflation. Not all that good, but on the back of that data, the fact that sterling has been able to hold up like this, for me, it bodes well if we're able to close today above that 53 handle. Any questions on the pound before we move off? Tricky spot here, but the levels are very clean. So we'll continue to watch either a breach above 53.80 or move sub 53 for further near-term guidance. In the meantime, it's a range, plain and simple. We'll be looking to hold that for now. So all these dollar crosses, guys, are in focus and are at really beautiful points right ahead of the Fed. Before we move into the crosses, I just want to cover one last thing, and I hate this trade right now, but I'm going to just look at it because it's going to be big tomorrow, I'm sure. Dollar CAD, or dollar yen, I don't even think it's worth it, guys, to look at this on the intraday. The only thing I'm looking at are how this thing is reacting on the major key daily levels. So if you guys remember, it's interesting because actually one of the sales guys at FXCM was asking me about dollar yen. He had a really big client who was looking at dollar yen, and you know, after that initial rebound off of 118, he was looking for a long position to get right back into like 126 and 130s. Look, dollar yen is likely to see a lot more upside in the long term, but it depends how much pain you're willing to take before that. By my estimates on this move here in momentum, failing ahead of 60, the breach of the upper median line parallel, which has offered really nice pivots in price, also failing after just one session. You had the 200-day moving average, which is right there. And here we are with a slamming right back to the downside. Look, I don't have no clue what this thing is going to do. I'm going to be completely front with you. But I do know what levels I want to watch. The monthly open at 119.88 is of interest. A breach above 121.75, 121.83 is what I would need to see to get back on the resumption of the broader uptrend. Beyond that, it's at risk for further breakdown. Now, momentum hasn't really been all that bearish. Okay, this was the first 40 break we saw in literally multiple years. So I'm still on the camp of you may see a new low here before all is said and done. But the fact that on this last pullback here, we rebounded and held 40 pretty well doesn't give me all that much confidence. So look, guys, heading into the FOMC, this is a notorious pair. Dollar yen is tends to be very sensitive to dollar data. You have GDP on Friday as well. So look for either a punch through 121.20, specifically 21.80 for the validation of the continuation. More likely, or more scenario I'm looking for, would be a break back below the monthly open and a move back towards basic trendline support that dates all the way back to that slope from August. And that slope is a mirror slope of a longer dated trend line that dates all the way back to the 2012 September lows. So there is sort of some targets here I'd be looking for on the downside if we're able to make it back below the monthly open. Now from an intraday prospect, I'm just going to show you the chart. I really don't have any like near-term levels that I'm very comfortable with as far as trading. This retracement is done and void. Let's do some on the fly here, shall we? $21.80, I'm going to leave that. That's the April high. Just want to see if there's any overlaps on this first leg down here. Oh, beautiful. Okay, so these are one of my favorite setups. 100% off the high, overlap with a retracement off the low. That gives you exactly 120.17, 120.18. We're testing that right now. Wouldn't stress that 236 anymore. Let's get rid of that. Okay, and you want to highlight these ranges as well. A little bit bigger of ranges, but the farther out you go, the larger the range that you will lock, guys, for where you want to find market support or resistance. These are both nice areas I would start looking. Remember, ATR here is so tight, which is another reason I don't really want to trade this right now. Only 19 pips. And could be an operative slope that's in play right now off the highs. Really nice, actually. So that gives you a major key support a little bit lower down here. This is going to be the confluence of the lower median line parallel, okay, the 1618 extension, and the 50%. That's 1977, 1961. And that's where I would expect to see a little bit more rigid support. If that breaks, I'd be basically looking for 118.70. Invalidation for the current short side bias. It would have to be here. I know that's really close. Looks like basically the next couple of hours. But near term, the immediate short side bias invalidation level for the short would be 120.80. A broader turnaround would be a break above that median line that we just drew. So guys, take a picture of this if you're trading dollar yen. Interesting right here. You could see some support. There's a 3-point trigger touch right there as well, which is in play. And could be actually a decent setup. I didn't think I would have had much to say on this trade. I wouldn't think I would have had that much to say on this trade as it stands right now, but levels are looking pretty good. The only thing I would caution you guys is 19 pips is pretty damn tight. Okay, so just make sure that if you are scalping it, you give yourself that room. Don't open it up too much beyond that. Any questions on dollar yen? All right, guys, that goes through all the pairs I wanted to cover today. Oh, Aussie yen real quick, and we'll touch on gold. Markets have just opened, so I got to run. But here's what Aussie yen looks like real quick. It's at a very interesting juncture as well. On the 30-minute, we were talking about this in yesterday's radar charts. Right here, and basically we were looking at a beautiful weekly opening range setup that finally gave way, okay, last night with that break below 87.40. Initial targets were right here at 87.09, and that was a 38.2. Next downside target is the 618 of the rally, of last week's range. That takes into 86.78. A little bit nicer of an ATR here versus the yen pair versus the dollar, which is only 19 pips. This is about 28 pips. It's a little bit larger, but momentum looks pretty good as far as a break finally below 40. All the stuff that we were looking for yesterday materialized with that break below the opening range low. Looking for a late week low. Soft support at 86.79, 86.80, but really a little bit more of a key confluence at the 618 extension off the highs. Let me just give you some reference on where that's from. And that coincides dead on, that extension, with the median line off the highs and gets you right about 86.47. Okay, near-term bullish invalidation, or bearish, invalidation is going to be with that upper median line parallel. So depending on where you are in time, the confluence of that, confluence of that actually comes here later in the week towards the 28th. So it'd be kind of a nice move here, back into the median line, and you start to look for long triggers here to play it back towards the weekly opening range low, which we've tested as resistance last night, and the upper median line parallel. So Aussie yen, also another one that looks actually pretty decent. My preferred yen cross versus dollar yen, or as opposed to dollar yen, but also looks pretty good. Chris Hudson says, wow, that's pretty clean on dollar yen. Yeah, sometimes it's surprises, right? The technicals just pop right out at you. Last thing I want to talk about real quick, I tweeted this chart, and it was on gold. I know we don't follow gold here super closely these days, especially since last week's lackluster price action, but we're at a pretty key major support. 1155, 1151 is the invalidation level. This is a weekly chart for the uptrend that we've seen off the yearly lows. So I wanted to highlight that in the weekly chart. But even on the daily, okay, you're coming at some major support, namely a basic 236, but that's nothing. Slope support, the defining slope off the lows, is into view right here as well. Notice the lows that you had from June trade as well, right there. Okay, the swing high from last month, right there. It's going to be this top range at the 1155, 1152 level we were looking at on the weekly chart. So gold has some very key levels heading into FOMC, namely key support at 1155, 1151. Resistance, you're basically looking at that 52-week moving average, 1180, just beyond where we maxed out last week. All right. I know time is up, but could you tweet your euro pound chart, please? Mark, here's euro pound, man. I'll show it to you real quick. Take a snapshot. I'll definitely tweet it out as well, but I don't want to make you wait. Here it is. We got a little messy on the downside here with that move below the channel support that we were looking at last week. But man, we took out all the targets essentially on that pullback. So let me just snap these for you. Here's what euro pound looks like on the daily. Okay, you could see a rally back up as high as this region here, and I wouldn't even be surprised. Former lower median line parallel, 200-day moving average, and there was something else there. I think it was the swing lows that we made. Long story short, I'm not really interested in touching this here. Euro pound, I think I only like trading when it's positioned against major levels. Like this resistance region here was huge. And the breakdown we saw and the reason that it held that median line kept the focus last week to the downside. Now, you're just above support. You don't really have much resistance nearby. Kind of lost focus. Okay, kind of lost focus here. I think it'll come back into a major player once we get through the month here to close the month, but not really looking to take any positions here. You know, a downside break of a descending channel formation typically is going to be the sharpest part of the move, and a topside break of a ascending formation likewise. Mark saying maybe a wider pitchfork. I think you're probably looking at something like this, which sure could be in play, and in fact that looks like nice support, but even that, resistance is way up here, support way down there. You know what I mean? You're mid-range. I hate getting to a scalp mid-range. I'll never do that, or I'll try not to never do that. I want to be as close to resistance or support as possible so I can ride a little bit more of a lengthier position through those levels. Also, I just want to bring your attention, Mark, to these trend lines, which we were working with for years. This is off the 2013 high, late 2013 high. Both of these, which defined price for over a year, right? The upper of the two grabbing the highs, the lower of the two, it's right along that pitchfork we just drew, right? The wider pitchfork that you pointed out, same level. So this different analysis results the same levels is all the more conviction that I need. All right, Mark says, I hear you. Wonderful. Thanks for showing it. Excellent. All right, I love the enthusiasm. Guys, got to wrap it up there. We'll be back on board tomorrow morning, 8:30 Eastern, for a pre-FOMC wrap-up, as it were, to go over the dollar pairs and possible positioning ahead of that release. Till then, best of luck trading, guys, and we will see you tomorrow. Cheers.